Hello and welcome to this Cornerstone Finance Group podcast brought to you by Business News Wales and sponsored by Hale. I'm Gemma Casey, editor of Business News Wales, and in this episode we're going to be looking at later life lending. Well, later life lending, including equity release and lifetime mortgages, can support people who are planning for longer retirements or have complex financial needs. So what is the current state of the market and what do mortgage advisors need to know to confidently support clients in this area? Well, with me to discuss this are Ryan Mansell, Equity Release Advisor at Cornerstone Finance Group, Will Hale, CEO of Hale, and Dave Harris, CEO of More to Life. Welcome all, thanks for joining me.
Thanks, Gemma. Nice to see you.
Thanks for having us, yeah.
So, Ryan, let's start with you then. Can you give us a little bit of an overview of what we mean by later life lending?
I think that's one of the big discussions at the moment around defining what later life lending actually is. I think the way I would describe it, it's the evolution of the equity release advice. We're in an industry at the moment where, even though since the mini budget we're in rates are a bit difficult, there's been a lot of innovation around from lenders and more people trying to get involved, more funders. So I would say it's evolving to, in simplest terms, kind of anybody over the age of 50 to 55 that are looking to release money from the property to either repay these mortgages bubbles that's coming over the next few years, or to improve their current financial situation around retirement and future goals. So, yeah, I think that's in its simplest form. I think there's a lot of people that would define it probably slightly different, but I think gone are the days of this is an equity release plan you're having, or this is a mortgage plan. It's what do you need from us? What's your situation, short term and long term, and then we'll find the right product. So I think it's more around the age rather than the product type now, with the ability to, offer a residential mortgage up to the age of 95, or look at the PTLMs that have come in, the Rios, and it's an exciting time for the time ahead, really.
And Ryan, to what extent do demographic changes influence this?
I think as a whole, the demographic is very similar to what it's probably always been, but people are more aware and more tech savvy. So I think the actual, the age range, the customer type, we'd like to say, from a client point of view, I think it's pretty similar to what it used to be in, 15 years ago. But their education piece, the people, I speak to more and more people every day who know about it, who've spent time researching it, who are more educated. So I think the conversations are getting stronger. I think we've moved away from the history of it, I suppose, probably in the early 2000s and before, into a really confident product. And I think that's testament to advisors, networks, lenders, sourcing platforms as a whole. There's been a lot of work from top to bottom, but yeah, I would say everyone's more informed and it's an easier conversation to have. But yeah, I've spoken to clients who definitely can do more things on a computer than I can.
Yeah, Gemma, let me just jump in there very quickly. So I think it's really helpful, as Ryan said, that we have a really clear definition of the market. And I think that simple definition for me of all customers over the age of 55 who are looking to borrow against their property. And I think it's really important we start with the customer rather than the product, because as Ryan said, products have evolved so much. So we're really talking about all customers over the age of 55 who are looking to borrow against their property. And on the demographic point, I think it's really important to know that we're actually talking about a very large number of people. So gone are the days, I think, where people look to take out their first mortgage in their early or mid 20s and have paid it down probably in their late 40s. Unfortunately, that's not the reality that most people face now. So we're talking about probably the vast majority of the population who are going to have to carry mortgage debt on their property into later life. And it might be for the entirety of their later life. So this is why it's such an important market and why it's great that we're talking about it today. And we're going to talk about how we can help more advisors, help more customers.
And Will, tell us briefly what AIR does?
So AIR is the leading intermediary services business in the later life lending market. So there's three parts to AIR's business. So we're probably best known for our sourcing platform. So we provide the most comprehensive sourcing platform for later life lending products in the market. We then run a mortgage club focused on supporting later life lending advisors. And that club both helps advisors achieve the very best remuneration terms from lenders in the market, but it also acts as a help desk for advisors to talk to someone about problem cases or complex cases, and works with advisors and lenders to find a home for that business. And then finally, and very importantly, given some of the conversations I think we're going to go on to have, we've got the AIR Academy, which is a sort of training and development resource, which helps advisors get into the market by providing them with help, information, and the support to get the qualifications they need. But also for advisors who are already active in the market, it makes sure they stay up to date with changes and innovations and supports them in ongoing CPD. So these are the three elements to AIR's business. We've got over 10,000 members currently. So as I say, we're by far the largest intermediary support services business in this part of the market. And we're really excited to try and take those services to an even wider set of advisors.
Thank you, Will. Dave, before I come to you on this topic, tell us briefly what is More to Life?
So More to Life is the largest lender of lifetime mortgages in this later life lending market. We have the broadest range of products with the lowest interest rates at the lowest LTV, all the way up to the highest LTVs that then carry a higher interest rate. So we manage a book of about 10 billion of mortgages that we've built up over the years, and we support all of the advisors in this marketplace, all of the networks in this marketplace with, not just good products, but increasingly the efficiency of how the end-to-end process flows is super important to both the broker and the customer. So that's been an area of a focus for us as well.
And we've talked already, Dave, about the demographics and the fact that more and more of us, if not all of us, to Will's point, will fall into this bracket. Some of us, it's creeping up closer than others. But to what extent is that influencing the market? And to what extent does this mean that mortgage advisors really need to embrace this now and make sure it's in their toolkit?
I think I'm the only one on this call that is over the age of 55, but, at More to Life, for many, many years, I've always said we need to have big ears and big eyes and look in front of us as to, what is taking shape in terms of what customers need, right? And the reality is, this is the fastest growing part of our society. We've got a lot more older people in our society than we've ever had, and we've got a lot less people who are younger and working, right? So that is a demographic shift, which is important because the people who are older do have a large chunk of equity in their homes. It's the biggest asset that they have, right? It's bigger than their pension assets. The first thing I did was I took out a mortgage to buy a home before I started saving into a pension. But the reality is that, as Will pointed out, it is now the norm that we're all going to carry debt into and through our retirement. That's going to be more prevalent than it's ever been. So, this is a very, very important market. When I talk to the CEOs of the other lenders, even the big banks, I sit on various industry forums. This is one of the fastest growing segments of the mortgage market in the UK. So it's super important that advisors bring themselves up to speed with what has been going on. They reach out and they understand the services that organizations like Will's has available to support them, and have a good look at just how much innovation there's been in this space, both, certainly within the lifetime mortgage market, but there are other forms of later life lending products that also exist. You know, as Ryan pointed out, there's RIOs and there's, you know, TOs that are available to older borrowers, and PTLTMs. These are all acronyms that actually just brokers should just realize there's been a hell of a lot of innovation. So they should really go and have a good look at this space because their customers need them, right?
Great. Thank you, Tate. Will, let's have a little look at what is happening in this part of the market then. So how is the current economic climate affecting these products?
Wow, that's a big question, Gemma.
Yes, in 2 minutes, if you can.
Look, I think all of your viewers will be sort of aware that we're living in fairly sort of turbulent times from an economic perspective. So it's sometimes difficult to sort of look into your crystal ball and predict sort of where the economy is going. But I think the really important thing to think about when looking at this sector and how products are priced is that there is a difference between lifetime mortgages and mainstream mortgages. So whereas a lot of mainstream mortgage advisors will be focused on their sort of Bank of England interest rate and look at sort of ups and downs and how it'll impact sort of rates in the mainstream space, that's not really the case in the lifetime mortgage market. So lifetime mortgages are generally sort of priced off long-term gilt rates. So what we've seen sort of recently is, although Bank of England base rates have eased slightly, actually, when you look at 15-year gilts, those have remained sort of frustratingly high. So over sort of 5%, sort of in recent times. So actually sort of rates on sort of lifetime mortgages have remained sort of slightly higher than perhaps sort of advisors have been used to. Certainly if you look back to the sort of 2022 and the mini budget. But what I would say to advisors is that sort of these are long-term products. So rather than get fixated on rate, and look, rate and cost of borrowing is always important, but rather than starting from that position, you know, start with the customer in mind. Think about what needs that customer is looking to support, and then think about if the product is right for them, irrespective of the rate that might be available. And although these products are called lifetime mortgages, I think also some of the innovation they talked about, these products don't have to be products for life. So you see a lot of remortgaging in this space as well. And Dave's business has actually got a very innovative product that contains no early redemption charges. So again, a product that allows advisors to advise with confidence in the market that is in front of them today, knowing that there may be other options for customers sort of down the line if the environment changes. Yeah. So I suppose my message is, look, I'm no better than anyone else in terms of trying to predict the economy and what impact that's going to have on interest rates in the lifetime mortgage space. There are so many factors that go into that. But advisors are there to give customers confidence to move forward with their plans. And these products can be life-changing, positive products, irrespective of the interest rate that's attached.
Just to add on to that, I think you're right. There's a lot of evolution in terms of defined early repayment charges, you know, no early repayment charges, the ability to service interest to stop the debt compounding. So then as the equity grows, annual reviews are quite big in this. And I think what I would say about the lenders, and Dave is obviously one of these, where actually after the mini budget, it was very turbulent, our industry. There was rate changes daily, up, down, you know. What I would say lenders are doing quite well at the moment is holding the nerve. I think when there is a bit of a spike, there's not an immediate change, which is kind of just projecting a little bit of calm across the industry, which is good. It makes it a lot easier. And I think we've got a lot of what I would say fairly new advisors. So following pre-budget where rates were 2-3%, I think we got a lot of people interested in the industry. Whereas if you've been in it before those nice times, I think it's not far off the norm. I think, you know, ideally maybe 1% lower as a starting point and some LTV brackets coming back. But generally, like you say, it's a product for life. So do what's right now, fix the problem, and then hopefully in the future we can revisit and support them again. Yeah.
And Will, the Financial Conduct Authority is currently looking at potentially requiring mortgage advisors to have a qualification to give advice around equity release. Where are we with this, and what difference do you think this could make?
Well, Gemma, I mean, the current position is actually to advise on equity release. You need a standalone qualification, so beyond what you actually have within CMAP. But as you point to, the SDA has launched a discussion paper around the future of the mortgage market, which contains a significant section on later life lending. And one of the questions I pose around that is, what are some of the barriers to preventing sort of advisors being active in this space? And certainly from an AIR perspective, we believe that the qualification piece is one area that needs looking at. So for me, for all the reasons that sort of Dave, Ryan and I have outlined, later life lending is now a norm. It's not a niche. All customers over the age of 55 should have all of their options considered. And that's why it's really important to me, maybe we just have a single qualification so that we have all advisors who have CMAP should be able to advise across the full range of later life lending products. Now, that doesn't mean that all advisors will choose to do so. And it's absolutely appropriate that advisors may decide to narrow the scope of advice that they offer and then refer customers who need these more specialist solutions to other advisors. But I think as a starting point, let's get everyone up to speed to really understanding the full range of products available and make sure that all of those options are being considered where appropriate for all customers. And qualifications sort of aren't a silver bullet, but they're a good starting place. And if we equalize qualifications, then I think that gives us a level playing field where all advisors can make sure that they're looking properly at all the options for all customers.
Ryan, you were nodding away there.
Yeah, I think that's been the biggest change, and one of the reasons that I've worked at a few different networks in my time, and having the option to myself now. Obviously, if I get someone inquiring in the later life section, I will consider residential mortgages as part of that, which I think what Will's saying there is spot on. It's nice to have the additional information that isn't covered at the moment, but if you can revamp it and actually just incorporate, these are all mortgages. They're all work the same. You've got the same protections, you've got some extra protections, but as you go into the later life. So I think, actually a review of that. But then it needs to come with the further support, as we've already touched upon with AIR and the academies and, networks doing a bit more to kind of promote that. But it's a good point.
I must say, Gemma, just building on the points made by both Ryan and Will, I think the fact that the FCA in this discussion paper have got a very distinct section asking for input on the later life lending market, I truly believe, and I've seen over the decade or so that I've been here at More to Light, I've seen various moments in time when it looked like the regulator was going to help shine a torch forward for us all as advisors to better support customers. I really do think we're at a breakthrough moment now. I do think that there's every chance that they'll make some good suggestions in terms of how things like examinations may or may not need to evolve. But the fundamental point for us all to be alive to is whether you're a specialist later life lending advisor or you're a mainstream mortgage broker that isn't specialized in later life, or indeed you're a wealth manager, right? You now have a phenomenal opportunity to connect yourself to this rapidly growing market, this rapidly innovating market. And great, there will be some people, as Will has said, I'm echoing what he said, who will decide to go on and equip their firms and themselves as individuals with the examinations. But there is equally a massive opportunity for them to make clear what they are there to do, the narrow advice or narrower advice that they want to provide, but they can have great referral connections then to people like Ryan. Right. So, we don't have to wait for the FCA and this discussion paper to allow us all to make better use of this vibrant market, this growing market. There's action we can take today. And I just sense that that's bubbling up all over the place at the moment. It's a really hot topic for everybody. I'm quite excited by it because it's what we predicted in More to Life would happen. It's why we've innovated with the products that we've got. So exciting times ahead for everybody.
Yeah, that's a great positive note. Now, I'm conscious of time. So with all that in mind then, and the opportunities that you so eloquently outlined there, Dave. My final question to all of you is, what would your advice be to an advisor who might be listening to this, who might be thinking, I'm not as au fait with all of this as perhaps I ought to be? Will, I'll come to you first.
Yeah, I see you there. It'd be remiss of me not to say the first thing you should do, I think, is register for AIR and benefit from all of the sort of help and support that we can provide. But in all seriousness, I think it is that first stepping stone as an advisor to recognize that there is, as Dave said, this is a great opportunity. And if I'm not equipping myself with all the knowledge and information around the innovation that's taking place, then there's a risk that I'm not producing the very best outcomes for my customers. And there's an even bigger risk that I'm not seizing the commercial opportunity which is in front of my business. So I think that's the first step. It's just acknowledge that this is a growing and important market, and I need to make an active decision about how I play in this market. And as Dave said, to me, there's two real clear options. You either decide you're going to advise yourself in this space, in which case you've got to equip yourself with the right examinations and make sure you stay competent and you've got the right tools and systems to support that advice. Or just as appropriately, you can decide to find a trusted referral partner you can work with, who you can hand off your clients to and have confidence that they're going to be given the very best options by that individual. And again, there's lots of ways that the networks or AIR can help support advisors find a trusted referral partner that works for them. So my one piece of advice is, as an advisor, you can't afford to ignore this space anymore. If you do so, you're not meeting your consumer duty obligations and you're not getting the maximum out of your business. So take an active decision around what you're going to do in this space.
Thank you, Will. Same question to you, Dave.
I'm going to repeat a number of those things, really. I mean, consumer duty is something that all of us now need to stand tall to. I think, my advice to advisors would be with those two words ringing in their ears, and against a backdrop of the FCA, in this discussion paper, clearly looking very closely at this space, at least spend some time now checking back and understanding just how much change there has been in the later life lending market. Properly bring yourself up to speed with the services that are available, in places like AIR. Think about, do you want to do it yourself as a growth node for your business, or do you want to connect to a great firm like Ryan's that you can refer to? But for me, the overarching thing, the thing is, lots of advisors tend to be about my age, and they've grown businesses that, have advised first-time buyers through the 80s and the 90s and the noughties, right? But the reality is, their clients are now as old as them, and ask themselves the question, what would I think about a mortgage that, or a stable of mortgages, lifetime mortgages, RIOs, TIOs, all available to me? I want to understand all of those options. And what do I think about a mortgage where all of the interest can be paid, none of the interest can be paid? You can have a zero ERC, or an ERC that is, perhaps as short as 4 or 5 years, right? That sounds a really good mortgage. Does it exist? Well, it does. So let's connect to it in ever greater number, because your clients need you to now, because they're my age, your age, and there's a lot of really good things that are now available to us. So exciting times for everybody, for sure.
Thank you, Dave. And Ryan, the final word to you.
Yeah, I think from my point of view, it is just putting that customer first. I think if you've got rid of the labels of products, like Dave just said, you judge it on what does that client need now. So I think education within Cornerstone, I've already had 2 advisors. So I did a session with them on Monday. I've had 2 advisors already that are interested in stepping into it. So not referring. So actually what we're doing now is we're doing regular drop-ins, coffee mornings, if they do get, just to help them grow, point them in the right direction. I think this industry is full of support, whether it's your local business development manager, whether it is your sourcing platforms, your lenders. That's where I would start off. I'd build that network first. So if you don't know the answer, you know to ask. And I think that gets rid of all the fear of any of it. And then the other thing is just removing, like I said, the client first, and remove our preconception. So if you're a mortgage advisor and you can do a 2-year fixed rate again on an interest only that finishes in 2 years, great. But what's the exit plan? Should we just be kicking the can down the road at the moment, or should we be actually saying, right, what is your long-term goal? It's to stay in your home. It is to make payments, right? Did you know we can secure your payment at a fixed rate for life, so it won't ever go up? If the rates drop, we'll review it to see if we can get you on a better deal. And I think that's what we've got to do now. It is, what is the long-term solution? We can't predict what's going to happen in 20 years. And that's the hardest thing of my job but with the flexibility with, downsizing protection, early repayment charge, waivers if one person passes, you have got so much flexibility. And I think education to introducers and to clients is vital. So if you just wrote down what you could do, I think people would call it a mortgage now because of that flexibility. And that's where we need to get. I don't introduce myself. I know we've titled it as an equity release advisor, but we are just, you've got an issue, you want to solve it with your property wealth. Let's have a look at it.
And so some great messages there. The overriding theme, I think, is the scale of the opportunity that is there for mortgage advisors. So thank you so much to my guests, to Ryan, to Will, and to Dave. And thank you for listening to this episode of the Cornerstone Finance Group podcast.